Good morning, everyone. Welcome to our webinar. We will be discussing our views in regards to the MPC and what our expectations are and what is actually driving those expectations. My name is Kanye Santondela, and next to me is Eben Mare. We're the fixed income portfolio managers at Mazi Asset Management. And we're going to start it off with setting the scene just so we can explain exactly what's really driving inflation currently and what's driving globally what is happening, the supply shock that we're all experiencing. So if we move to the first slide, we just wanted to first show you guys the oil curve. Yes, yeah. So you can start there. Yep.
Thanks, Kanyisa. So thanks for your valuable time. What we're showing you here is everybody's obviously aware of the war and the fact that oil has gone through the roof. Central banks have been fairly moderate in their reaction up to date, and part of it is explained by the oil curve. What you can see here is the forward expectations or the forward curve on oil, and you can see that going out further, the market has been in backwardation, which means that the expectation was that supply comes back. So you're still waiting on that. You can see the longer term forward curve hasn't shifted significantly, which is good from an inflation expectation perspective. But the problem here is still how long it takes for this matter to be resolved and the demand destruction that's done in the background. If we skip to the next slide, in sort of unison with this shock, we also have the biggest economy in the world in the US, where we target inflation and employment. We're above our target. Core inflation, core PCE, has been well above the 2% target for a while, despite the fact that the Fed has been sort of trying to get rates lower based on some political influence, if you can call it that. So the reality here is the market had been expecting inflation to, or the Fed to move rates lower. But if you look at the FOMC minutes of last night, there was a strong preference to actually start looking at raising rates in response to the oil shock. If we then go to the last slide that I wanted to go before Kanyisa talks is you can see US PPI has reacted quite violently to the oil shock. And that sets the scene also for our own situation. So what we want to do in the next slide is we want to try and get a sense of how the SARB is going to look at things. And obviously we're not part of their meeting, but we're sort of making a guess, right, Kanyisa?
Yes, we're making a guess based on their own mandate, and their mandate is price stabilization. So it's all about inflation. And so to us, we need to just assess, where do we expect inflation to be going? What is currently driving inflation, and whether it's within the band that the SARB actually has. As much as they've got the 3% target, they do have some form of room. If it hits 4%, at least they're still comfortable. But if it goes beyond that 4%, they need to start acting. And that is where we are currently. We have started entering that zone of, we are at 4%. Is this 4% persistent? What is going to continue to drive it? And what is our expectation for next week as a result of all of this? So if we move to the next slide.
Before you move, so what we're saying at the moment is we actually think the SARB will hike rates next week. We think we're at that part of the cycle, and we'll explain why we think that. Also try and explain what the reasons are. The SARB's obviously trying to counteract the so-called second round effects of inflation, and I think there's evidence of that already and the logic behind that. So we sort of think that you might have some dispersion amongst the view. We think probably you'll have at least 3 members of the committee saying that you hike by 25, and there's probably some room to also say, look, let's just hang on a bit longer. And that has been the case with a number of central banks, sort of starting to saying that let's just wait a bit. The shock is bound to be over, and we don't want to do damage.
But are they in the same situation as South Africa is the question, because these are countries which are, for example, with the US, they've got growth that's a trend. They've got low unemployment, but they've got an inflation problem.
Yes.
And so it's not a situation that's the same as South Africa, where we do have high unemployment. We really don't have growth, but we have a central bank that needs to focus on their mandate of we need to control prices.
Yeah. Look, I think if you wanted to make the growth argument, growth is going to be a problem everywhere. A supply shock like this creates a growth problem down the line.
Yes.
There's nothing you can do about that. It's like being in a car crash. You just need to manage the consequences now. So that is going to be one of the things. But the SARB needs to live to their mandate. That's what we believe.
That's what we're thinking.
On the next slide, we start to actually make that situation. You want to take?
So we're looking here at SACPI, which is that brown color. Unfortunately, we have a lot of browns in different shades. So you've got SACPI, which is sitting now at 4%. You've got goods inflation, which is actually not picking up as fast as what we are seeing in services inflation. And on top of that, we've got this trimmed mean, which is the black line. And you can see that the trimmed mean is starting to turn and actually go up. So the big thing that we're trying to highlight here is a lot of it has to do with services. A lot of it has to do with the survey that came through specifically in financial services and insurance. So there was a bit of repricing that came through there. And when it comes to goods, yes, goods are starting to pick up. Yes, we do have a currency that's gone a different route as to what we were expecting previously. So there are a number of factors which are actually driving the CPI up. If we go to the next slide and we look at the difference between core and looking at headline inflation, you can see here with that mustardy brown, this is what's happening with inflation, but what's concerning to us is what's happening to core. Core is moving in the same direction as headline inflation. And so we were sitting there going, what's actually driving this core number? Because now we've excluded oil, we've excluded food, and we've excluded any form of energy. So any shock is out of these numbers. So something must be driving core further. And as I said previously in the previous slide, it has to do with the survey, it has to do with insurance. That factor actually came up this month. And that's the main reason why you're actually watching core moving in the same direction as headline. If you go to the next slide and we actually look at the breakdown between what's really driving core and headline. Eben, if you can take it through.
Yeah, it's normally nice to actually have a look at core and headline, and just to get a sense of the correlation between them. And what you can see here is we were in a regime towards the end of last year where the longer term correlation was moving lower, which is a nice environment to be in. What happens now as a consequence of the shock is you actually start seeing the correlation pick up. So that is some evidence of the second round effects. And we'll dig into that in a second on the next slide. So what we've done on this slide is just a scatter plot. So on the horizontal axis, what we actually show is the non-core inflation rate. With other words, we take the difference in a given period of the core minus the headline, and that's negative at the moment. And what you normally find is if that gap is negative, in the subsequent year, core inflation goes up. With other words, core reverts to headline. That's the problem. That's where your second round effects come in, not the other way around. So what happens here is you tend to find that you think that you don't have second round effects, you've got a shock, but what you actually have is structurally you've got a pickup in your core rate. And we're actually starting to see early evidence of that. And I think that's a very strong argument in favor of the Reserve Bank actually having to do something to counteract that specifically. You can actually, as Kanisa said earlier, talk about what the growth effects are. That brings you into the event of what the sacrifice ratio is. And the SARB, when we lowered the inflation target, made that point is that it's actually lower than what has been envisaged.
And And if we go to the next slide, we're just looking at inflation expectations. And unfortunately, this is a quarterly survey. So the last time it was done was towards the end of quarter 1. It was actually February. Numbers were looking fantastic. We're headed towards the 3% mark. But I think for a short period of time, this will revert, this will turn, but it won't be like a quarter 1 story where it changes. It's probably a quarter 2, quarter 3, and then once things wash out, once we start seeing that the second round effects have come through, then you'll start seeing it or expectations actually going back and reverting to that 3%. And you can see from this graph, things were going the right direction. We were headed to 3%. Even businesses were expecting it. Analysts were expecting it. Trade unions were actually starting to believe it, which is what the SARB actually wants. So things were going the right direction. It's just unfortunate that we walked into a supply shock,
100%.
because that is what oil is. It is a supply shock, and things have just turned.
I think this slide is important, and it's obviously going to be very important down the year when the BER releases the second quarter survey in late June. But the problem is now what we're trying to do is to say, okay, so where are these bound to come out? And we can make a guess on that. So if we go to the next slide, what we basically see there is we do look at the trimmed mean, which gives us a good sense of sort of the trend of inflation. And you can see there's a good fit between the trimmed mean and the so-called break-even inflation. The break-even inflation is just the difference between inflation-linked bonds and nominal bonds. And what you see there is the line that we tied together at the left of the graph is actually what inflation and break-even inflation has done from the start of the year. You can actually see they've moved clockwise. So what tends to happen here is break-even inflation has moved significantly up while you still have that the inflationary effects are lagging. So what the market is actually telling you is that most probably your inflation is going to move higher if you actually just move horizontally and you see where that line should fit. So basically the market is telling you here you are getting higher trimmed mean, which means the trend has been moving higher in relation to what we actually said earlier.
So all it's really saying is instead of us reaching 3% in 2026, we're reaching 3% in 2027. It's just a delay effect, which is something the SARB already factored into their assumptions.
Correct. If you actually look at the scenarios that they painted at the start of the year, I think which was quite prescient, was to say, if we have an oil shock and the rand goes, we still get back to our target. It just takes longer. So I think that ties to what you were saying.
That is what's happening. So we go to the next slide and we actually break down that core inflation. And yes, I needed to show you guys exactly what food has been doing. And you can see in that mustardy brown, food has been going lower. Food is actually benign. Nothing exciting is happening there.
Surprisingly.
Yes, but meat is meat. It's still going up. It's still elevated. But the point of the matter is the rest of the basket in food is still stable. And please note, when it comes to any form of planting has happened already. And the next planting season,
we've been lucky.
Yes, we've been lucky. So we're going to be missing out on any form of agricultural shock, i.e. fertilizer prices. I think that will come in closer to at the end of the year.
Later in the year.
Yes, when the next planting season actually comes through. So that's how we're going to be lucky on the food side.
But that's us. That doesn't. That's not the rest of the world.
That's not the rest of the world. Yeah. So when it comes to fuel, that's what the big shock was. It was the fuel price. It wasn't the entire transport basket. It was just primarily what happened to fuel, which is what we had expected. We first thought we're going to have an increase in April of 9 Rand. It became 6 due to the fact that they used the fuel levy. And then the following month, which is going to be May, we're going to have the same situation again, but luckily it's at a slower pace because now it's half of that amount, it's around about 3. So that part of fuel is going to continue to be driving things.
But I think your point probably is that we've not felt the full shock, so we're still going to bound to see more of that come through.
It's going to continue. So at least now we're factoring in month one, which was April,
100%.
month two, which is going to be May, and then we should see some form of normalization starting to come through.
The good news at the moment is we actually have an over-recovery diesel.
Indeed, which is the most important thing. Because diesel is 100%. What drives PPI.
Quite correct.
Not petrol.
Yeah.
Trucks are not driven with petrol. Trucks are driven with diesel. So the more we are seeing this recovery that's coming through, wonderful. That means any form of cost that's coming through for any form of manufacturer, it's working out. Transport costs will be under control when it comes to actually June.
Yeah. Well, if there's not a further shock to the oil price, I think that's the big problem here, is everything is contingent on what happens with further movements in the oil price, 100%. If the oil price moves significantly, I think worldwide, that becomes a growth problem.
Yes.
Because it actually kills consumption. It changes consumption patterns. So this is the problem here, and that's why central banks have been waiting to try and see the extent of the shock. So,
very true.
Yeah.
So if we move to the next slide, which is I was just trying to show here what's happening with administered prices, what's happening with headline itself. With administered prices, this is us looking at what Eskom is doing, looking at us with what the gas is doing, all of those type of things, all these administered prices. And as you can see, administered prices continue to actually come up. We do see a lot of news coming out of Rand Water as well, which is the biggest impact for us. We are seeing a lot of burst pipes throughout Joburg, and I'm sure people sitting in Cape Town as well are seeing similar things. But that is what's happening with water, and the Western Cape is going through a lot. So when it comes to administered prices, that continues to actually also go up, which means we are going to continue to also see some form of pressure coming through in headline inflation. And you're going to start seeing more issues actually coming through in core inflation as a result of what's happening to administered prices. Because when you're doing core, you're not taking out administered prices. You're just taking out fuel. And you're just taking out food. So if we move on to the next one, which is just, we were just trying to look at the trend of what happens to when inflation moves, what repo actually does. And you can see here, you get the lead coming from inflation, and then you're just watching repo moving straight afterwards. So right now, we're seeing a situation, a trend where we were going down, but now it's starting to pick up, which means we should be expecting repo to also start picking up, which supports our argument of maybe, hopefully, they will put through a 25 bp increase next week, because it's the only way they can actually stick to their own mandate. It's the only way they can actually continue to be seen as independent. And this graph roughly illustrates that they need to move with the trend, or they need to move with their mandate. Now, the next graph is what's our biggest concern. We went and we looked at retail sales. To us, as much as everyone was excited, we are at 2.3% or 2.6% year on year. The reality is the trend is not picking up higher. The trend is showing a strained consumer. So inflation is not going to be coming from a demand side of things. Inflation is coming from a supply side of things. And that's the only thing that's really going to drop it, actually drive it. And if something comes up where things recover supply-wise, then you're going to see inflation go back to that 3% mark. Right now, it's not going to be driven by the consumer. The same as growth is not also going to be driven by the consumer. It will be driven by supply. And that's it. So what is our summary about our expectations for next week, given all of this that we've seen, we've said?
Yeah, thanks, Kanyisa. So we think the SARB at their meeting next week becomes more hawkish. They need to tighten conditions in line with some other central banks that have done the same, and in line with some of the sentiment expounded by a number of other central banks. I think the SARB needs to get in front of this and actually move higher by 25 basis points. If the oil shock subsides, it is very easy to actually then resume the trend that we had pre the war. It's not necessarily great to try and steer the ship and change courses the whole time, but that's not what the SARB wants to do here. They need to stick with their mandate. They need to actually say there's a concern here. We are starting to see the direction of travel, and we need to act in line with that.
Yeah.
I think what Kanyisa highlights here with this slide is the concern that we all have with growth. We're not coming from a great base. We had some great green shoots towards the end of last year, growth starting to pick up, very low base, and the concerns here are real. But that doesn't mean that the SARB doesn't take their mandate very seriously, and actually
It's all about credibility.
It's the credibility of the target, 100%. We're very happy to take any questions. That brings us to the end of our presentation, and we really appreciate the opportunity to share those views with you. If there are any questions, we'd be very happy to talk to them.
If you have a
Nolita?
question, please can you raise your hand and then I can unmute you so you can speak.
It's early morning. Either the shock is too big. So,
Yeah.
cool. We've got one question, Nolita.
Good morning, guys.
Morning.
Oh,
Uh,
shame. You were unmuted and then boom. There
Can you hear me now?
Try again.
Yes, we can hear
Hear
you
you
now.
now. Thank you.
Perfect. Thank you. I was just saying, thank you for a very detailed and insightful presentation.
Thank you.
Just a quick one from my side. I heard you mention that you think that the SARB might start hiking as early as next week. Also heard the governor mentioned that they need to act very early. He actually made reference to some Zulu war. What are the FRAs saying? Maybe I might have missed it in your presentation. What are the FRAs saying with regards to expectations going forward?
So if you look at the NCDs, for example, you've now got that the NCD rates, which were earlier in the year pricing around about flat, now have moved up by 100 basis points. So earlier this week, your one-year NCDs were trading closer to 790. So that means that the curve is priced in a bit more liquidity concerns, as well as the expectation that rates are going to be hiked by at least 2 times, arguably, debatably more than that. And you've had the same out of the FRAs as well. It's debatable whether we see 2, 3, or 4. I think 4 hikes as we stand overdoes it, but I think you do definitely see at least 2 rate hikes as we stand. Thanks for that question.
Yes, so it's been priced in already by the
100%.
FRAs that there should be some form of increase next week.
Thank you very much. Any